Are you interested in how you can put your home equity to work in retirement, but maybe a little bit scared of the words reverse mortgage? Well, this video series is made for you. I'm going to walk you through the basics of the reverse mortgage step by step so that you can make an informed decision about your financial future. And remember, always check with your family and a licensed financial professional before you make this or any other major financial decision. Now sit back and get ready to learn the truth about reverse. Hey, if this is your first time here and you'd like to keep learning more, please like this video, subscribe to the channel, and tap that bell for notifications so that you can keep learning right along with us. Those over age 62 have amassed more than $13 trillion worth of home equity, and it largely sits idle during retirement. My name is Brian McRae, and I'm here to change that mindset because every day I see how profoundly my clients' lives can change when we put a well-designed reverse mortgage in place. Reverse mortgages aren't for everyone, but in the right circumstance, they can be an extraordinarily powerful financial tool that will help you thrive in retirement. If you have questions about the home equity conversion mortgage or reverse mortgages in general, if you have a family member or a friend with a reverse and you have technical questions, I am more than happy to help. Please reach out to me. My contact information is in the description right below. You can call, text, email. I'll be more than happy to answer any questions that you might have. In today's video, we're going to talk about one of the questions I get all the time, and that is, why are reverse mortgages so expensive? And if you put them side by side, if you put a home equity conversion mortgage next to a traditional mortgage, the costs look like they're almost double. And so it is an extraordinarily expense, and it is something to consider when you're considering whether or not the reverse mortgage, the home equity conversion mortgage, might be right for you. In this video, I want to talk about these costs in a little bit more detail and break them apart so that you can understand exactly how to compare them and exactly how the costs are different. Because most of the costs are going to be the same across traditional mortgages and home equity conversion mortgages or reverse mortgage. You're always going to have title fees. You're always going to have a lot of those third-party closing costs that come along with every mortgage. Both traditional mortgages, traditional mortgage loans, and reverse mortgage loans, home equity conversion mortgage loans, typically have some origination fees associated with them. The calculation is going to be different across these different instruments. And so for the home equity conversion mortgage, the origination fees are 2% of the home's value up to a maximum of $6,000. And so, there are origination fees with most types of loans, but the way that those fees are calculated is specific to the home equity conversion. As we start to get into some of the other costs that are specific, the out-of-pocket costs, the first one is counseling. Every borrower, everyone who applies for a home equity conversion mortgage has to go through a telephone counseling conversation with a third-party counselor. I think this is a great idea because it lets a third party look at the particulars of the home equity conversion mortgage and explain to the client, make sure that they understand exactly what they're getting into. Now, that cost is out of pocket. It's paid during the application process. It's typically around $150, so it's nominal. The next out-of-pocket cost is the appraisal. This is an FHA appraisal, and so the appraisal will cost whatever the third-party appraiser charges. That's typically out of pocket. And so the biggest component, the large component of the expense of the home equity conversion mortgage is the mortgage insurance premium. Now, that term is a bit confusing because it's not the same as the mortgage insurance premium you may have heard of for traditional lending. This is specific to the home equity conversion mortgage, and it speaks to insurance that's used to cover a very specific gap, a very specific risk, and that is, if we get to the end of my reverse mortgage and I go to sell my house or I move into care or I pass away, what happens if the home's value isn't enough to cover the loan balance? In other words, the loan balance is bigger, it's larger than what the home can be sold for. Well, this is a loan of no recourse. It's one of the most important features of the home equity conversion mortgage. And what that means is only the home can be used to stand for this loan. And so in the instance where the home's value comes up short, the owners or their heirs cannot be held liable for that shortage. And so in that case, this insurance steps in and fills that gap. It's like gap insurance for your house almost. And so everyone who gets the home equity conversion mortgage has to pay this mortgage insurance premium. It's 2% of the home's value up front. And there's an ongoing 0.5% tacked onto the interest rate to maintain that insurance going forward. And that represents a very significant expense. It's the bulk of the reason why home equity conversion mortgages are so much more expensive than traditional lending. So really important consideration. It's one of the reasons why people tend to shy away from the home equity conversion mortgage is the expense. But when you peel back the onion and you understand the purpose of that expense, it really lends itself to one of the best features of the home equity conversion mortgage, which is the security of knowing that no matter what happens to the loan balance, no matter what happens to the real estate market over time, only the home can ever be used to satisfy this note, and there's no recourse against the borrowers or your heirs if this loan should come up short. And so make sure you have this conversation with your retirement mortgage specialist so that you fully understand these costs and factor that into your decision about whether or not it might be right for you. So there you have it. That's the main reason why home equity conversion mortgages are so much more expensive than traditional lending. And aside from the ancillary expenses, the bulk of it comes down to that mortgage insurance premium, which, as we've established, plays a very important role in protecting you or your heirs or your estate with the no recourse feature. So stay tuned for our next video when we dig a little bit deeper into the implications of the maturity of the home equity conversion mortgage and understand the 4 options that are available to you when the reverse mortgage becomes due and payable. Until next time, keep on learning the truth about reverse.